And so what we are worried about and what the Fed is worried about is that you are going to see economic growth slow, unemployment go up, and that is why they want to have these insurance cuts. We don't think insurance cuts will be enough. We actually think earnings growth is not going to be 7% this year. It's going to be -5 and maybe even -10.
So we've already established this isn't for real people trying to raise real debt. This is for the market, okay? You said that it's for the market. So just to move on, these pessimistic CEOs have been giving more money back than ever before to shareholders via buybacks and dividends. Billions and trillions of dollars, actually, I should say.
Yeah, absolutely.
But they're getting more and more pessimistic, but they're loading up more and more debt on their books. Is there something wrong with the corporate model?
I would say that yes, there is, Steve. I think, as you know, companies that don't actually invest for the future are actually not going to be worth what they are. And when we look at record levels of PEs, you've got the Schiller PE back over 30 times, last seen in the tech bubble, last seen just prior to the 1930s depression. When you look at the trailing PE in the US market at 22 times, higher than it got in its highest level in the 1960s Nifty 50 period. This is a recipe for a really sharp correction in global equity markets at some stage in the next 18 months. And I mean really large, because we are looking at these recession risk models rising. Credit impulse numbers in the States are weak. That tends to bring unemployment up and tends to bring equity markets down.
Often we have a debate about what's required at any point in the cycle, because we're debating whether an interest rate cut or hike or whatever it's going to be will actually be delivered. The market and the commentary that we got from Powell yesterday seems like it's a done deal. July will deliver a 25 basis point rate cut. If that is the case, what do markets do with it? Because it's not fresh information. There's been a lot of movement already in the stock markets, as we've seen in record levels on major indices. So is there more in the risk on trade?
Well, I think that you buy on the rumor and you sell on the news typically. I think our concern
is we sell in 3 weeks is what you're saying.
when you have seen the type of scale of ISM declines that you've had in the last 12 months in the States, when you look at the weakness of the banking sector around the world, typically central banks would already have cut 150 basis points. So I think that's what the futures market, that's what the bond market is already telling you, that there is a weaker environment out there and that is more stressful, and that's what we'll be responding to.
And so you sound pretty bearish on the U.S. economy. If I can assume we are heading to a recession based on your line of thinking, is there a number of cuts that the Fed could implement that could avoid a recession or help the U.S. economy to actually avoid it?
So I'm not saying that that's where we're going, but that is what the models are actually pointing to. That's what the Fed's own models are pointing to. And when you look at what you've seen in the past, when these recession risk models go up to these kind of levels, guess what's happened? Fed rates have been cut by 400 basis points, and 10-year bond yields have fallen by 200 basis points compared to their previous 2-year peak, and the yield curve has steepened 150 basis points. The only way that I can reconcile those numbers is the Fed funds rate in the next 18 months will probably head towards zero.
You typically don't have growth rates at this level when you get those types of percentage cuts, do you?
Well, no, because normally what's happened is that economic growth has started to slow down, and we are seeing that growth slowing down.
So it's a leap of faith if the central bank were to take that type of action at this point.
It's why they push rates up in the first place. And remember that rates have gone up. The last time that we had coordinated monetary policy was back in 2017. Everybody came out of the BIS meeting in June then, and they said we're going to normalize rates. Why do they want to normalize rates? So that when things slow, they can actually cut rates.
And the problem I have with your commentary is that it doesn't match up with what we heard from Powell. And effectively, he was talking about some of the Fed members, and in the minutes you could see it, that they were allowing the unemployment rate to drift even further south because it was not triggering that typical pressure on wages. So they're almost giving us the narrative that the economy can run a little bit hotter this time round.
But I think that's the classic situation you get in late cycle. In late cycle, economic growth slows. We've already started to see the nominal income growth numbers decelerate. They are at high levels, from 6.5% down to 5.5%. But we see those wage rates carry on even as economic growth starts to decelerate. But that is the point where you get pressure on earnings, pressure on cash flow, and that is where you actually then start to see pressure on the credit that Steve is so excited about, the fact that everybody can raise so easily. We will get a credit crisis in the next 18 months to 2 years.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.